CPAs are trusted with the hardest financial questions, and whether it's said out loud or not, your clients, especially high net worth clients, assume you're thinking about more than compliance. They assume you're thinking about what happens when care enters the picture, not just if care is needed, but how it destabilizes the plan, including their taxes. Here's the problem. Most clients don't have a care income plan, which means when care begins, the IRS quietly becomes a partner, an expensive one. Without a care income plan, families do what they can. They pull from taxable accounts, often at the worst possible time. They increase ordinary income, they trigger capital gains, they accelerate IRA distributions, all to pay a non-optional expense. That income doesn't just fund care, it reshapes the entire tax picture. Potentially higher federal tax brackets and potentially higher state and local taxes, and very often IRMAA surcharges, not just for the spouse receiving care, for the healthy spouse too. Two Medicare premiums increase while only one person is receiving care. That's the ripple effect. Some clients assume that this will be handled at tax time, medical deduction, problem solved. Except it rarely is because they must itemize, giving up the standard deduction. They lose the first 7.5% of AGI. They track and document every receipt if they don't lose them. And many still don't clear the hurdle. Meanwhile, AGI is already inflated because income had to be created to pay for care in the first place. It's circular and it's brutal on retirement projections. This is where the real damage shows up. The healthy spouse watches retirement income shrink, assets drain faster than modeled, their lifestyle downgraded in real time, vacations disappear, discretionary spending tightens, long-term plans quietly unravel, not because of market risk, but because of unplanned care expenses and the tax consequences tied to them. What most clients and many professionals don't realize is that care funding has evolved. There are now highly creative planning options available, strategies that can leverage life insurance death benefits so there's a payout whether care is needed or the client passes away without ever needing care, making highly appreciated annuities tax-free, and options that allow for the strategic use of retirement dollars, including inherited IRAs. There are plans that can provide lifetime care income for one spouse or for two. This isn't the old flip phone version of long-term care insurance. These strategies have evolved into powerful, tax-efficient, estate protective planning tools when designed properly. There are ways to create leveraged tax-free care income that don't inflate AGI, don't trigger IRMAA, and don't force liquidation at the worst possible time. But most clients don't hear about these options from their CPA, and they assume that silence means this must not be an issue. Care income planning isn't investment advice. It isn't estate planning, and it isn't tax prep. It's damage control for the single largest unplanned expense in retirement. Your clients already expect this risk to be considered. The only question is whether it's addressed before the tax return tells the story. Care does not just affect families, it affects outcomes, including taxes, which makes this a CPA conversation too. Thanks.